Good morning, Property and Propenomix people. Hello. And hello, Propenomix people, and welcome to another live version of my Sunday supplement. This week's was called Ring My Bell. Now, why was it called that? Well, because of Torsten Bell, the former chair of the Resolution Foundation, who is now significantly influential at the Treasury. He's an MP these days, MP for Swansea West, I believe it is. And has been involved, was constrained before to pensions reform, but now has a much freer hand over what's going on in the Treasury. And if Keir Starmer was to get rid of Rachel Reeves, as many have speculated, as I talked about several weeks back now before the summer started, could well be in the shaker to be the next Chancellor of the Exchequer. So an important individual aside from anything else. So this week's is called Ring My Bell. And I started with a quote, as I always do. The bell never rings of itself unless someone handles or moves it. It is done. And that's from Plautus, the Roman playwright. So that is looking forward to the deep dive, as I say, and what Mr. Bell is advising, and what certainly a bit of speculation around what he's done in the past. So it's putting Torsten Bell under the microscope a little bit. But before I get into that full hammer, Rod Turner and I will be running our next property business workshop on Wednesday, the 1st of October in London. Subject matter this time around is investment, with an emphasis on what metrics you really need to be considering to run your property business properly and building your business to scale. So we'll dig into the real fundamentals of property investment for growth, proper valuation, strategic debt structuring, to the investment metrics that serious pros use. So there's a hint there, you'll be ditching ROI and yield. But you'll also learn why some deals work for some and not others, how to manage the risk as your portfolio scales, and when to shift gear from side hustle to scalable business. We're going to break those bottlenecks, build some strategic pillars, and unpack some real-life case studies of fast company growth. How have we done so many deals? Well, we'll tell you. You can still book the super early bird tickets with a genuine 20% discount off the full price of the tickets, which we always sell some at full price as well. So hurry up and get them now at bit.ly/PBWEIGHT. And there's also a link in the show notes. So I'll plow on with Trumpwatch. What's gone on in the USA in the past week? Well, his moves to get tougher on crime versus illegal or legal migration have gone down well and have improved his polling. He sent the National Guard into Washington, D.C. Then, of course, the sacked Federal Reserve Governor Lisa Cook filed a lawsuit. So that sets another precedent here. That's never happened before in the US, and there'll be a preliminary court hearing. Questions were, of course, asked about the actual independence of the Federal Reserve. Now, just wait until there's a Trump simp in charge of the Fed next year and see what questions there are about independence. But eyes were on the White House as Trump met with Blair to discuss a post-war reconstruction plan for Gaza. Must have been an interesting conversation. And the migration medicine for the week was shortening foreign journalist visas from 5 years to about 8 months. GDP growth was updated for Q2 to 3.3% annualized after their disappointing Q1, when the economy went backwards 0.5% annualized, as we are told. So a big difference there in terms of how the US has done in Q2 of the year. And of course, big claims of success for Trump and fans. This led to yet another stock market high and yet another swathe of predictions of when this bull market would be over, along with a few voices saying there's plenty of runway yet, particularly if interest rates are to come down by hook or by crook. The labour market's looking a little soft with poor jobs numbers. Consumer confidence also fell. There's always been an overall path downwards for 30-year mortgage rates, but they're still at 6.56, a 10-month low, unlike the 30s in the UK, which we keep hearing about busting, nearing the nearest high since 1998, keeps being wheeled out as a headline. But the housing market remains jammed up in the States with sales falling. Cuts became more likely to the interest rate at the September Fed meeting, according to the Fed commentary, or at least the market's interpretation of it, mostly based on a weaker economic outlook. So not too dissimilar to the UK situation at the moment. Do you really want rates down at all costs is the trillion-dollar question. And if you're a big borrower, maybe you'd say yes, you would, and hang the recession that might happen. Without a big catalyst, it won't be a deep, dark recession. It'd just be a very stagnant thing. But without a proper recession, we won't have a proper clear out of what needs to be done in the market with government policy and all the rest of it. So it's a very, very difficult balancing act, but then it always is. And then there was a recent poll about the approval rating for tariffs. 61% of Americans disapproved and only 15% actively supported it. Some agricultural states are experiencing layoffs, and that's not helping with economic anxiety within them. And of course, you'd expect those to be traditionally Trump voting areas. So anyway, we press on. The real-time UK property market. Chris Watkin delivers once more. Week 33 is in the can. Listings printed 33.4k, edging up a touch as we get to the end of the school holidays, and we're now only 3.3% higher than 2024 and 7.2% higher than the pre-pandemic market in terms of listings year to date. My 10% more stock than a normal market ready reckoner is still working on the back of about 2 years of overperformance in listings compared to the historical averages. But I did see a stat that was actually sent to me by Chris yesterday, and we had a chat afterwards. I'm having a talk about bringing him on the channel. So if you're listening, Chris, hello. If anybody else wants to comment about having Chris on the channel, someone suggested it to me, and I thought, well, I haven't done much in terms of interviews and things like that, so why not give it a spin? Let me know what you think. It won't replace this supplement broadcast, of course. It will be something extra. So get Chris on for a chat potentially. But that stat was 53.6% more property on the market today than 3 years ago, than exactly 3 years ago. Now, it's a little bit naughty. Maybe it is because 3 years ago we were looking at real lows in terms of stock. That's cleared out by the pandemic, really. Not enough listings, many places being bought, but still a huge, imagine that difference for estate agency windows, the whole industry. Now, of course, we're not selling 53.6% more houses, of course. So a lot of that stock is wasted or is sitting there on the market at unrealistic prices, not being cleared out. But that's the stat nonetheless, so I thought I'd share it. We're 11.3% ahead of the 9-year average in listings, but I always have to say that includes 2020, which pollutes those figures somewhat. But it's only 1 year in 9, isn't it, really? Although it had further impact, as I was just saying. We're really inching back towards the 2024 numbers now, week by week, because we were 6 to 7% above them at various points this year, but now only 3.3 ahead. But we're still listing more than we're selling, which is always the case. So it really just depends on how many get withdrawn as a rule. Only 20,300 price reductions in week 33. 14.1% is still July's official number. We're still waiting for August because we run a week behind with these figures, remember. 14% reduced in June. Last year was 12.1. May was 13.4. The 5-year average is 10.6. It's still holding true that more stock you have, the more reductions. About 33% more reductions than the 5-year average, if you look at the difference between 14.1 and 10.6. 25% more reduced properties than a normal market is also working as a rough ready reckoner. 1 in 7 being reduced each month. So maybe 90 to 95,000 price reductions a month, to be clear. So if you say you can't find a deal, I think keep the legwork up and you'll get there. You don't tend to see 14% plus of stock being reduced in strong markets by any stretch. Holidays have slowed things a little, but the sideways pricing just continues. It's as simple as that. 25,300 homes sold subject to contract. That nudged up slightly. This year, average is 26,400, and that's healthy. Sold subject to contracts are up 6.8 year on year, 14% up on 2017 to 19, and still nearly keeping pace with 2022, which at this point in 2022 was a very hot market indeed. Sold subjects up 6.8, but listings only up 3.3, as I've said. So plenty more transactions than 12 months ago to this point in the year, or perhaps better described as a more functional year in the market than 2024 was. What will be interesting is that the price rise for 2025 will be less than the price rise for 2024, but 2024 was a bit of a recorrection, really, on the back of a 2023 very cold, going backwards nominally market, while inflation was battering away at house prices and lifting wages up as well, of course. As we went into August, we had 763,178 homes on the market. So as I say, next week we should have September's number, hopefully. About 5,000 up on July's number, which is not much when you're talking 750,000, obviously. But the market got stickier before the pandemic. That number was about 660,000. So 760,000 is a lot, right? The seller's market looks more like under 600,000 normally, if it's being driven by stock levels. At the end of July 24, 716,000 were on the market. These are much more high numbers. And this flat feeling I've been saying for some time now will likely continue to manifest itself in a steady market without much excitement as we get through the school holidays. It's the second month in a row of not moving too far forward, though. Fewer than 1% more homes on the market compared to the month before. It feels like we're nearing or are already at the peak. We can't read too much into August activity anyway, but there's always an extra surge in September when the school holidays are over, alongside a clear out of no hope of stock where vendors mostly can't take the medicine the corporate agents are trying to prescribe for them. So we likely need to see those figures before drawing conclusions. as they could be somewhat different this year with just so much stock out there. Chris also looks at the per square foot on sold subject to contract properties, a very strong correlation with prices that hit the land reg in about 5 months' time. So this time round, July was £344.78 a foot. Again, we should have August numbers soon, within the next couple of weeks. A couple of percent higher than July 24 and nearly 4% higher than July 22. But down about 0.5% on June's sold subject to contract number, which was £346.45 a foot. And it's all this noise up and down. You're seeing this in the price indices when they get released. Massive fusses. You know, Reeves crashes housing market with talk of property tax was the Telegraph headline the other day when Nationwide released that the house prices were down 0.1% in August. I mean, I think they know their tongue is in their cheek there, and they'll do anything they can to have a go at Rachel. But nonetheless, it did make me chuckle. My original prediction was 3.75% for the year. It's looking like we'll hit more like 2 to 2.5 at the moment if we carry those numbers forward 5 months, which, as Chris always says, has got a huge 92% correlation with what happens at the land reg. A very, very strong correlation. So fall throughs, though, trickled back just above the long-term average of 24.2, but only just printing 24.3. So pretty normal noise. There's been very little volatility around the long-term average for many weeks now. The net sales are still there or thereabouts, 19,100, 5.6 up on last year, 10.6 higher than 2017 to 19. Not quite 2022 levels. We're about 16,000 behind now in total. But let's see where we get to by the end of the year. I think it'll be a close run thing on transaction volume compared to 2022 at the end of the day in a much less volatile year. I always give Chris this weekly shout out because he's much more prolific than only this epic tome he releases weekly on the UK property market. He's always coming up with some great regular stats. Drop him a like, a follow, a subscribe, all the rest of it, and some kind words for his content creation if you don't mind. If you're in the industry and you want support growing your business or to be more effective communicator, be more in touch with your local market, because that's his core business, then give him a shout. The article gets published on the Property Industry Eye website and the video on his YouTube channel, which is at Christopher Watkin. Okay, over to the macro mismatch that seems to plague the UK fiscal and monetary policy at this time. It's been a very quiet week with all the action starting on Monday. We will take a look at the MHCLG right to buy statistics for the 2024-25 fiscal year because they've just been released. The ONS released their household cost indices for Q2, so we'll take a look at those as well. Slightly different way of measuring inflation. And then I couldn't squeeze in Rightmove's asking price index last week because it was so full of macro treats. So I'm going to take a look at that this week. And then at the end, we'll be talking gilts and swaps, of course. But of course, you knew that anyway. So right to buy. You remember it. Not really talked about much these days. What does the total ticker look like now? Well, 2,036,848 homes have been bought under right to buy since 1980. And that was the figure up until the 31st of March this year. A lot of concentration early on in those days of the scheme. So I always say you have to be careful around the early 80s numbers when it comes to house prices in terms of deals that were being struck, because you were talking over 100,000 transactions a year based on significant discounts. So it did give a falsely low impression of what house prices were. Of course, if all those houses are trading at a 25% discount, let's say, and that's 10% of the market, then prices are 2.5% lower reported than they otherwise would be. And 2.5% in this day and age, we're talking about a year's capital growth around and about, as I say, for 2025. So making a significant difference to the figures. And of course, in the early days of the scheme, many of the houses that traded were more than a 25% discount. So I'm just throwing that number out there and explaining to you how that might pollute the figures for the early 1980s, which are often cited as days of affordable housing. Well, of course, it was affordable if people were getting 30 and 40 and more % discounts. Far fewer homes now bought these days. And of course, the rules have been changed so many times, we can't even go through it and it'd be meaningful. So the annual average, which doesn't really work when you think about that concentration I've just talked about, but nonetheless, it's been 45 years since Right to Buy was introduced, and it's a little over 45,000 homes per year. What about in the last year? Well, 7,494 sold and 3,593 replacements. So 48% of homes were replaced. A little bit more on that later. That 7,494 was actually 7% up on the year before. Replacements were up 4%. What was the average receipt per dwelling? £106,500. I don't think you'd deem that a particularly high price to pay for a house these days. I'm sure you'd agree. Now, of course, these are social housing, etc., etc. But of course, they're also all over the country. So it sounds pretty cheap when the average house price is somewhere between about 260 and 300, depending on which one of the large indices you prefer. Very few of them ever comment on why that is. That big disparity that they have. I probably trust more like the ONS, although they've changed their ways of measuring the average house recently. So who do you trust? It's not easy, right? It's not easy. But sales have dropped from the more recent sort of 10 to 12,000 level after the maximum discount was tweaked downwards. So in this year, 40% were new starts in terms of replacements and 60% were buybacks. This usually of ex-local authority properties, so they only buy back what they built themselves, which the cycle repeats. So interestingly, sort of 7,500 sold. How many are getting replaced? You could argue, well, right to buy is a good thing because it puts more houses back into the build mix, but only 40% of 3,500. So what's that? 350, 700, 1,400 homes. 7,500 sold, 1,400 new build replacements. And there's some other interesting stuff about the product mix, which I'll also go into. But it's probably just because building is so expensive for local authorities and for everybody. The 1-for-1 replacement target fell a few thousand more behind, as you can see. The replacements are about 25% one bed, 43% two bed, and 32% three beds or more. And that's since 2012, those stats. And that compares to sales of 14% one beds, 33% two beds, and 53% 3+ bed. So you can see what you've got here. You've got not just a loss of units, but you've got a loss of the size of what gets bought back or rebuilt. Now, you could argue that there are demographic shifts to smaller households which justify that. But you know that the pressure is on 3 beds and above, not being removed by replacement, especially if you only replace 48% of your sales anyway. You can see fewer and fewer bigger social houses in stock and Right to Buy doing their bit on that front. Okay, what about household costs? Well, a bit of a different measure of inflation, basically. And they were up nearly 4%, 3.9%. And this is done in quarters, this report. So this is to June 2025, according to the ONS. The figure to March 25 was 2.7%. So a fairly significant spike in household costs. In this report, they split their households by decile, so by tenths. So then they compared decile 2, so that would be people between 10 and 20% in terms of income. If you stack everybody up in terms of household income, their costs were up 4.1, whereas decile 9, which they compared to, was 3.8. So close, but still, as always, inflation is harder on households with lower incomes. What about private renters? Well, they had household cost inflation of 4.5%, which would still reflect the fact that rent increases are above household costs. Social rent households experienced 4.4%. Outright owners were at 3.4%. Mortgaged owners were at 4%. Working households saw costs up 4%. Retired households at 3.8%. Those with children were also a tick higher at 4% versus 3.9% for households without children. The point of these inflation figures is to complement CPI, CPIH as a measure of inflation and give us a bit more insight as to where the pressure is on households. And I actually used the graph as this week's image, so you can find that on my LinkedIn. You can also find it these days on the Property and Poppadoms website, thanks to James for publishing things on there as well. Household costs are up above inflation, and they have been throughout this inflationary cycle. Now, it's very clear this gap has narrowed. We just had a CPI print of 3.8, but that was for July. It was 3.6 in June, so 3.9 for households, 4%, 4.5% for renters. You can see, as most people would normally expect, the costs are up more for the households who are in a lower income bracket and who are renting. So where does this fit with my ongoing analysis? Well, the way I've been framing it in the supplement and also in presentations I've given is, however and wherever you live, it's become a lot more expensive to run a household. And with the graph, you can see how much more expensive. Don't let things get out of kilter because wages have moved upwards significantly, but it's still a good representation of the size of the problem. What about Rightmove's asking price index then? Well, the typical August drop happened, but it created some headlines because asking prices are now down 3 months in a row, and some people are insisting it's some kind of canary in the coal mine. It isn't, in my opinion. I often point out how the Rightmove index has asking prices around the £370,000 mark for 2025 versus, as I say before, house prices on average that are Nationwide, Halifax, whatever else, that are 260 to 300k. So there's a huge disparity between those figures in general. And so when a market becomes more realistic, and I'd say the agents have absolutely caught on to the fact that you need to be realistic to sell property. And August also chivies them along, and I think it empowers them a bit because they say, right, we need to get prices down because it's August and there's not many people looking, school holidays, blah, blah, blah. But year-on-year asking prices are up a mere 0.3%. First-time buyer stock is down 0.4% in asking price compared to the more expensive second steppers and the top of the ladder, as Rightmove calls them, at 1 and 1.1% up accordingly. To be crystal clear, there are asking prices on new listings rather than Rightmove overall, so around about 100,000 homes per month or a shade more. How do Rightmove frame it? Well, buyers have the upper hand. New seller asking prices are £10,000 lower than on average compared to 3 months ago. If you want to sell it, price it keenly, basically. Sales agreed in July were the highest since 2020, so let's not pretend the market isn't functional. It's just found a way to cope with all of this excess supply, and the agent patter around the country is matching this. The Rightmove advice: act fast to reduce to find a willing buyer. Sales agreed are up 8% year on year, although homes for sale are up 10% year on year, as I've been saying. 34% of homes are seeing at least one reduction during their marketing period. Rightmove also says that the rate cut will help to boost activity. This one I'm not in agreement with, given what's going on with the gilts and swaps. Now, the 2-year gilt rate is unmistakably down, however, and I do tend to get bogged down in the 5-year rate because that's what I use as a proxy. That's what I watch very closely. I use the 5-year fixed rate mortgages. The report concentrates on the much lower chance of another base rate cut this year, without really focusing on the fact that the past 12 months has seen no real movement in the 5-year rate, a bit longer than 12 months actually now, to be honest, more like 18 months. And we were at the stage where the ratio was around 2.5 to 1. So there were 2.5 5-year mortgages, 5-year fixes, to every 1 2-year fix. Now, that may well not be the ratio for first-time buyers. We don't get those figures from UK Finance. Many first-timers seem to think in 2-year cycles, it seems to me, perhaps because they're being optimistic or they're just younger and more ambitious and want to move up the ladder a bit quicker. So this month shows every area is down, which is a very typical August, but London asking price is down 2.6%. Wales broke even, so technically not every area was down, and they were top of the shop by breaking even. And the year-on-year changes in asking price vary from 3% up in Wales year-on-year and 2.9 in Scotland, down to minus 1.6 in London and minus 0.8 in the southwest and minus 0.1 in the southeast. Could that just be down to investment money migrating because it has to for leverage? Probably not. Realistically, it wouldn't have that much impact. It's solely the impact of, with much more expensive mortgages, it's just much harder to get financing and pay those big prices in London unless you've got a really big salary, really big household income. Then the gap between the average asking price for a first-time buyer and what a single person can afford on a 4.5 times average salary is smaller than it has been for the whole of the last decade, which is very congruent with my recent analysis on just how cheap property actually is in real terms and in comparison to wages, in spite of what the papers and all the rhetoric says. When London gets split into its component parts, Westminster asking prices are down 7.9% year on year. Now that compared to Richmond, who dropped 4.7% on asking prices just in August, but are still up 4.8% on the year. So it shows you the local differences that there are. Much that correlates with recent analysis here from other sources, as you'll know if you listen regularly. But onto the gilts, you again, I've mentioned those headlines already. Highest yields or lowest values in the bond market, most expensive debt, however it gets framed, for 28 years or since 1998 is normally the words that are being said. Some people are calling that 28 years for some reason, when it's blatantly 27 years ago, and that's what we quoted last week. It's all more of the same sort of stuff. In the long run, the bond market is clear. Get inflation under control, demonstrate it's under control. Otherwise, we want a big term premium for long-dated debt. We opened at 4.16 on the 5-year yields for the week. Obviously, it was a short week because of the bank holiday. Should say that. That was a big gap up from the close on the Friday before, but that Monday is not a bank holiday around the world. It's just in the UK. I say in the UK. It's actually just in England, I believe. It might be in England and Wales. I'm not sure, but I know it wasn't in Scotland. So there's still movement around the world, which suddenly gets reacted to on those sorts of days. But then it declined again as the week went on to close at 4.111. So the shorter dated debt is still not too problematic. Thursday's close at 4.099 correlated to the swap close at 3.762. So we've got to bear in mind at the moment, although all these headlines are going on about the 30s and all the rest of it, where are we getting punished? Long-dated debt, index-linked debt. That's where the UK is really suffering at the moment. The rest of the stuff tending to decline a bit. And also, I keep seeing articles about how retail demand for gilts and, well, not swaps, you wouldn't have retail demand for swaps, but certainly in the gilt market, retail demand is at record levels. People are buying government gilts at the prices that they're seeing, and they're enjoying what they're seeing. So what about the 30s, though? Well, we gapped up to open at 5.615, closed the week at 5.605, so the yield curve moved a little steeper once again, it seems. The market seems convinced at the moment that 5.6 is about the right price on the 30-year gilt. The headline I shared that really sort of caught my eye was the UK market, bond market, is drifting without anchor, which did make sense to me. But with all that in mind, I was going to do the deep dive this week on the prospects of an IMF bailout and a repeat of the 1970s. However, because this is so very unlikely in my view, mostly because the independent central bank and the free floating currency, our debt is denominated in sterling, people are happy to hold sterling, we're in control of our currency, we're in control of our central bank, we're not beholden to, for example, like France are, we're not beholden to the European Central Bank. Now, they've got a similar sort of malaise. Remember, people retire earlier in France. Their bond yields are lower at the moment. Inflation's actually under control, but growth is anemic. And we must remember, we're at the moment going on a track towards spending 45% of GDP on government spending, which is very, very high for the UK, but it's not high necessarily by European standards. France is close to 58% of their GDP on government spending. So if you think we need to shrink the state, imagine what some in France think, but they're relying on the state for a huge, huge amount. And again, I think what the markets are doing at the moment is they're just looking out into the future and saying, this is not a sustainable pathway. We don't know when the trigger event is going to come. Are we likely to have a political party with some courage come in and say, and you could do this, especially if you had a longer than a 5-year term, but you could do this as a relatively painless process, right? You could say, I tell you what, bond markets, what we're going to do is we're going to only spend 80% of our growth in government receipts, right? So I'm not talking about putting taxes up here. I'm saying we tend to collect about, at the moment, 37 to 38% of every bit of growth in GDP, right? So if GDP in a year grows by, and again, we talk in nominal terms, we talk in real terms, we always talk about GDP in real terms. If we grew by 1%, which was where my sort of predictions were on the higher end for this year, it looks like we might do a bit better than that, which is great, mostly because the government spending has been growing so much, which is problematic. So that's a Pyrrhic victory, if you like. But if we stuck with sort of 1% of GDP, if we said, look, we grow about, in real terms, about 30 billion every year. So let's say 80%, which seems hugely generous to me, 80% of that growth can go in government spending, right? So that's 24-ish billion, right? If extra government spending in real terms, that's after inflation has been applied. So all the index-linked stuff is taken care of within that assumption, right? 24 billion extra in government spending, but that's the cap, right? We're only spending 80% of the growth, and that means that 20% is going into, guess what, paying debt down. Now, you could do something else. You could put it in a sovereign wealth fund, for example, if you thought you could vastly improve on the returns that you pay on government gilts. I'd be tempted to do whatever was most expedient with the gilt market, to be honest, because what would that do on its own? Well, it would say to the gilt markets, well, hold on a second, we're talking about long-term fiscal responsibility here in the United Kingdom. And what we're going to do is we're going to say, look, we've had these huge events, we've needed huge stimulus and various solutions to try and smooth over them, sort them out. That would include COVID, that would include the great financial crisis, of course. Wouldn't really include Brexit wobble in all of that, personally. Some people also separate the energy crisis. There was obviously a link to COVID in there, but there was significant disturbances in energy. So we could say that, and that would suddenly become fiscally responsible. And over the next 50 years, when you projected it, which is where the big payments are coming at the moment, 30 years, 20, 30-year government bonds and beyond, it would bring those yields down. Those bonds would be more desirable if we were going to commit to that in law. We're still increasing. This is not austerity, right? This is saying over the next 50 years, we're going to make that recovery, right, that we need to because the state is spending too much money. We're not going to cut it in the now necessarily. So how do we get more? Well, we grow more. And that's the only way we can do it. And that will bring us back over time. Now, look, I'm not saying my 80-20 is the right numbers and all the rest of it. I'm talking about having a fiscal rule of that sort from year to year. And then you have to deal with that in government departments. And as I say, it's not necessarily cuts. But what it would mean is things like the triple lock would have to go, for example, because it's over and above the rate of inflation and you couldn't guarantee it anymore. So that would have to go. There'd be all sorts of things that would have to go that were above inflation payments. You could cope with CPI plus 1, actually, in most places as it goes, because you would feel that would be all right as long as it wasn't across the board in every bit of government spending. Otherwise, you'd be spending 100%. It would still work in the growth forecasts, right? Because the growth forecasts tend to assume 1.6 to 1.9% for UK growth. So you would, if you were talking CPI plus 1, you would actually be able to save quite a lot more than that. But you wouldn't need that across the board. And we'd like to see some efficiencies that we've been promised via AI, via all sorts of other things if we can. Although you worry about the companies that are providing AI consultancy to the government and how close they are and what sort of numbers are involved. I'm sure there'll be a ton of scandals about all of that in the future. Private Eye has already started reporting on that stuff for the last 6 months or more. So there's bound to be some callbacks to things that they've said, because they've got a pretty good track record in this department of undercovering how efficient or not the government are. Anyway, back to the gilts, right? So we had these this 5.6% rate on the 30 years, this drifting without anchor. I've just kind of explained to you how I would sort that out if I was given the freedom to do that. So I haven't done this deep dive on the chances of getting the IMF in, because I don't think there's much chance of it. If you were particularly interested in the politics and economics of France, it would be much more interesting. I think it's more navel gazing and headline grabbing as they just keeping the pressure on Rachel Reeves as much as possible. But it's no surprise that it's going on after she drove one more stake towards the heart of the non-working person, daring to make any money from investment. So what I'm referring to there is the idea that's floated of national insurance on landlords specifically. It's just such a terrible idea, but I'm going to go into that. And I'm going to go into a few of the ideas that have surfaced of late. This terrible sort of, let's test the tax appetite out or whatever. What do you care what the public think about tax? They hate it, right? Trying to buy political points by taxing the rich. That's really the only agenda that Labour have got. Well, just sort something out. Every tax is going to be unpopular. Trying to do overall popular tax raises is ridiculous, because as everybody knows, if you're just going to try and tax the 0.1 or the 0.01 or whatever percent, you just don't raise enough money. The money is in income tax and it's in VAT, both of which are extremely unpopular, both of which probably need some element of reform and putting upwards in order to fill the black holes if you want the state to be the size that it is. And that is the truth of the matter. And I do refer constantly to Jeremy Hunt's poison pill of dropping national insurance from 12 to 10 to 8 for employees' national insurance. So where income tax was 32% at the basic level, it's actually 28. One of the other things I would do, again, if I was involved in policy, I'd be honest with the people and say, look, we need to get that 28 back to 32. There's no way around it, but look, we'll get back to it over the course of 4 years, 1% a year. So hopefully it'll be largely absorbed by your pay rises and you won't see a massive difference. But this extra money is going to help us, because it's going to help us get inflation under control. It's going to help us get borrowing costs under control. It's going to help people borrow. It's going to help landlords pay lower rates of interest. So everybody's costs in terms of rent, in terms of mortgages, should come down or at least go up less than they were going to. That would be the primary driver for me. But I'm going to go into a few of these ideas, and I'm squeezing Torsten Bell into this whole thing. Some of these ideas, of course, offence, some element of fear. I heard Dan Needle on the Rest Is Money podcast saying he really doesn't like the way they do this at all, and I'm inclined to agree with Dan. I don't think it's economically helpful. It brings uncertainty. It means brings inertia to the market. It means people find it difficult to make decisions. It leaves people questioning what's the point of growing their businesses and all sorts of things like that. You could read that sentiment if you look on social media, if you look on LinkedIn particularly. I'm not huge user of the other platforms, but I do like LinkedIn, and it's pretty good for reading the room. Use it for a lot of polling, informs me about what people are generally thinking. Now, if you're not familiar with Mr. Bell, I have been reporting on him since back when he was the chair of the Resolution Foundation and now MP for Swansea West, I think it is. He's probably the best qualified economist in the government, frankly. I'll include Rachel Reeves in that if we consider her true CV, of course. Although it appears in the past week she's not been the only one who's been a little bit liberal with the truth of her background. Kemi Badenoch has also not been immune to any of that either. But of course, that's politics, right? But firstly, what about this applying national insurance to rental income? I can't describe it any other way than all the way wrong-headed. What should be happening, as I've said several times, is that you should scrap employees' national insurance. Income tax should be the one rate, the 28%. As I say, creep it back to 32 over the course of 4 years. That would catch all investment income, including pension holders. That feels a lot fairer. The higher rate would be 42. The additional rate would be 47 on the current numbers. Just isolating the landlords to do it, well, A, doesn't raise anywhere near as much money, and B, it's just going to push rents up even more. You know, renters' rights are about to be signed off. There are no rent controls within that bill. Of course, there are all these new ways to challenge that are more effective than before when it comes to rent increases, but there are not controls. Do it for everyone, but still a more likely shrinkage in supply. But if you sell up and put the money in the bank, you get the same treatment on the income. So you're not going to sell property so you can get interest income, which is what a lot of people do, especially if they've got to an age where they don't really want to take any risk anymore, and they don't necessarily want to put that much effort in anymore because it takes effort to be a landlord. You would want the same treatment on that income. Now, mine might sound a bit vindictive here, but actually the national insurance thing is the vindictive thing if you pick on landlords, right? I mean, landlords must be used to this by now. We've had 10 plus years of vindictive, unfair, retrospective, money-hungry changes to the tax code. Tax revenue from the source could go down, of course, if you only make it about property. Likelihood of doing it, limited, in my view, but it depends how popular it looked when it was floated. Certainly delighted some on the left who see it as another way to re-examine rent controls. Even they understand that some stock will be sold off on the back of this. If we do go back to the 70s and the Labour administration that few will remember fondly, there was an investment top rate of tax of 98%. Yep, 98%. The top rate of income tax was 83% at the time, bear in mind. And Dennis Healey, the Chancellor's famous phrase at the time, was squeeze the rich until the pips squeak. Now, I probably don't need to remind you about the winter of discontent, and also there were a lot of loopholes to this in the 70s, just as today. Tax planning wasn't drastically different to what it was today. There weren't a lot of people paying that rate. But it just set the scene how Margaret Thatcher could come in and sort of drain the swamp of these terrible ideas, which are well past any concept of the Laffer curve. Of course, you're just not going to make much tax revenue at 98% because people aren't going to work, are going to move, are going to find ways of shielding it. Just imagine how many loopholes were being exploited. It was quite incredible. So the surcharge, right, the investment surcharge, which coincidentally might be at the same rate of basic rate of employers' NI, 8%. But Torsten Bell, who was, as I said before, stuck with pensions reform, but has now got a much wider brief and has got Rachel's ear and respect, and maybe soon even has her job. You never know if Keir Starmer has to try and save himself and ditch Reeves in order to stay in place. Bell will be one of the people he might well consider. He has previously suggested that levelling income taxes across income sources was a good, progressive and fair idea. So don't say it too loud, but he's probably right, to be honest, as I say. Employees' NI is a horrific tax. I can argue for 20% or lower capital gains tax fairly easily, but arguing for 20% basic income tax when employees pay 28%, it's a real struggle, right? It washes out at the higher level, as I say, so 42 instead of 40, 47 instead of 45 at the additional rate. No one likes it going up, but Mr. Bell does have a real point about fairness on this one. So if you're making huge gains, it's not going to be a huge difference to you. 8% on the marginal, it'll actually be the marginal 50k, wouldn't it? Because you'd lose your personal allowance if you're making huge income gains passively. So £4,000 a year. But in that case, you were making over £150,000 investment income. It's not going to make anyone cause anyone a massive problem. or over 125,000 investment income, I should say. Sorry, it's a few percent. Of course, nobody likes taxes going up, but there is a fairness point on this one. How about some of his other bright ideas? Well, align the self-employed national insurance contributions with employed national insurance contributions. Raise dividend tax rates. Well, I think this one fails on fairness, really. The companies paid 19 to 25% corporation tax, although what this means in the real world is that people with small companies no longer extract via peppercorn salary and then dividend. They'd probably go and pay the national insurance apart from anything else. But any retirees but the national insurance is already taken into account with dividends. That's what happened when George Osborne re-examined the dividend tax. So I don't understand how that's fair. They just wouldn't. They just extract via salary instead. But any retirees who were on small shareholders in listed companies would then only get about 60 pence on the pound on net profits. So we're talking 25% to HMRC in corporation tax and then 20% on the remainder in dividend tax. So it doesn't really seem fair that they would be, one way or another, paying 40% tax rate if we're talking about fairness. Mr. Bell's also talked over the years about reducing the top rate of tax banding. While you're at it, you could remove the personal allowance for all higher rate taxpayers between 50 and 100k, and that would address this 100k cliff that currently exists. There'd be a new but shallower cliff at 50k, but what you could do is bring it back to 50. You could split it between 50 and 150. So there's a much smaller cliff there that exists, and it's not going to put anyone off from breaking the 50k barrier, which already has a barrier to it because it's the higher rate of tax aside from anything else. So stop this wastage that's occurring around 100k, because the 60+% tax rate, marginal tax rate, people face at that level is inherently unfair. Broadening the base for higher taxes is absolutely where we're going in the future, currently only via frozen tax thresholds, which I've been moaning about, analysing, of course, since they were effected in 2021 to 2022. So Bell has indeed written of smoothing out the thresholds. So on that subject, we are on the same page. Don't have these silly cliff edges. Agreed. Regular revaluations to council tax bands, like in Wales, has also been proposed, and also making it proportionate rather than banding. So council tax becomes 0.8% of the value of the property, for example. He's also talked about halving stamp duty, but he wants to finance that by lowering the VAT threshold, I warn you. So talking of cliffs, it's the greatest cliff in the game. Business is turning over just under 90k. Now, this one is a toughie. He suggested a 30k start on the basis of digital tax these days, VAT compliance being easier. It will certainly help to level the playing field on many markets where there's lots of non-VAT payers and it becomes a real barrier to scale. It would also be somewhat inflationary in these sectors because the non-VATable players would be shrunk by a huge number and 20% would be going on top of what they sell. So, the reward of halving stamp, I bet you wouldn't be halving the 5% additional rate, Mr. Bell, I'm sure. Well, maybe. Not his worst idea, is it? So we lower VAT threshold, we cut stamp duty. Very few economists are a fan of stamp duty as a transaction tax, although as I analysed last week, there's plenty of other countries in the world, almost everywhere else, it costs more to move house. It's just where our money is going in stamp duty, it's going to the government. People don't like it. In most other parts of the world, it's going to the private sector, it's going to notaries. There are plenty of transaction taxes and things like that around, actually, when you get looking at them. But they normally they're going to realtors who charge 5 and 6% in certain countries, But he's also talked about capping the lump sum pension drawdown to perhaps as low as £40,000 and then taxing the rest at the marginal rate on drawdown over time, subject to income tax. Sneaky, but again, who's to say what is fair here? It's all rather subjective. How about CGT? Well, all the figures tell us that if CGT goes up, it's not going to raise more money. People stop selling. However, he's mentioned factoring in inflation, so many recent gains would not be gains at all anymore after inflation in recent years. That is more like a reform than a rise, and it might work, but the introduction of an exit tax when people leave the UK would likely be the most unpopular of all, although the general public may be hugely in favour. To introduce an exit tax, it needs to start at midnight on the day of the budget. To be clear, anything else would be ineffective. Would it be nasty? Yes. Politically motivated mostly? Yes. It wouldn't raise a huge amount, but it would also change behaviour, of course. Imprisoning the wealthy in the UK is the way it would be painted, of course. But like I say, tax isn't popular. He's also been associated in the past with a per mile surcharge of electric vehicles of around 6p to reduce fuel duty. So you pay for what you travel. It's a very economically sensible from an economic point of view, politically hugely unpopular, you'd imagine, although perhaps not for electric cars, because they might well be conceptualized for as cars that for people who've got more money, aside from anything else. Now, there'll be lots of environmentally conscious people who've bought electric cars, of course, who are not necessarily got a lot of money. I know the Dacia Spring I saw advertised the other day, electric vehicle for 15k. That's brand new as well. So I see plenty of EVs changing hands these days at under 10k. So you could argue they're eminently affordable to the vast majority of people who often have two-car households and stuff. If they're outside London, anyway, I appreciate not many two-car households in London that are of people with lower income, unless they both need them for work, of course. So would there be an exit tax? I don't know. Would this 6p electric vehicle surcharge come in? Well, look, fuel duty leaves a massive hole in the exchequer, £25 billion or more per year. And when there's no internal combustion engine cars left on the road, however you replace that 25 billion is politically challenging. You know, a nice market in disabling EV GPS systems would probably come into play if they start measuring per mile or whatever. But he's also proposing linking road tax to vehicle weight. Again, now that does sound inherently fair. The heavier the vehicle, the more toll it takes on the road. So that does make sense. What about his last one? Well, I'm going to have to declare real support for this one. Scrap the triple lock. Triple lock is unrealistic, unaffordable, and it needs to go. Let them eat CPI, I say. So just to be clear, I'm still saying rise pension in line with CPI, but not with the other promises in the triple lock. The collar would still be 0% just in case we had a year of deflation, and we did come close during COVID. Sometimes it happens. It's very, very rare. It's rare at the moment with the amount of inflation we've got in the system. But he wants a smoother earnings-based system, but it doesn't go far enough for me. Why should the rise be above inflation? You just pile in more and more pressure each year on the remaining workers when you have a record number of people retiring, engaging the current Overton window, a limited appetite of the country to keep importing enough people to fill the gaps. Something needs to change there. That much is clear. As per a lot of the more political analysis, though, I often end up in the same place. Some of these sound great on paper. They're genuinely fair and raising more money, which is needed to operate the NHS. Cuts aren't coming in this parliament unless there's a genuine crisis. We've seen evidence of that. Cuts are absolutely needed. Don't get me wrong. I saw a screenshot of a property application this week, which a few more might have seen, which is someone including their benefits, including carers allowance, including disability living allowance, had the same income as someone on a £42,000 salary after tax. Something can't go on in that situation because that person simply has no incentive to work ever if they're able. But these cuts are not coming. I can already see Nigel Farage with a chainsaw before the next election. Hold that thought, folks. But before I do close, don't forget to go and book your super early bird tickets to the next property business workshop that Rod and I are running on Wednesday, the 1st of October in central London. This time around, investment metrics and how to run your property business at scale. My favourite topic of all. Book at bit.ly/PBWEIGHT. There's a link in the show notes. And above all, please remember to keep calm. Always listen to the supplement and carry on. There's going to be opportunities abound this year, and as we go towards 2030 and beyond, the landscape's been set for a surefire bull run. It's going to be slowish to get started, take a while to get off the ground, and the amount of stock is still keeping things suppressed at the moment. But as yields currently continue to improve, it's a case of here we go, in my opinion. Thank you, everyone.